Hello, and I'm excited today to welcome another great guest, Michael Saylor, who's a founder, chairman, and CEO of MicroStrategy, a company which provides business intelligence, mobile software, and cloud-based services. So Michael authored a book, The Mobile Wave, How Mobile Intelligence Will Change Everything, and he's also a founder of Saylor Academy. Hi, Michael.
Thanks for having me, Konstantin.
Yeah, no, I'm really excited because we're going to talk about your big move in acquiring I would say, hefty amount of Bitcoins, right? We're going to talk about the rationale behind it. We're going to talk about different strategies and how do you generally see this world, the new economic wave, according to your book as well, right? And before that, there's a traditional disclaimer. So this content is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or any other advice. So now we're off the hook, right? We can just, we're in chain. We can talk about anything we want. And first, I want to begin with the question, how did you get to this crypto rabbit hole, right? What actually inspired you in this entire journey?
I think all the monumental developments of 2020 instigated this. We weren't really focused much on our treasury strategy. I think the path of least resistance is keep all of your excess treasury assets in cash or short-term sovereign debt. I think we wouldn't really take more than about 1 or 2 years duration on a bond, and we would clip the yield. In good years, we generated 5 or 6% interest on that, and then in other years, 2%. I think the rapid decrease of interest rates to 0% and the prospect that we would never generate interest on any of that cash again prompted us to start thinking about the problem a bit more. So if you had a bunch of money and you thought you were rich and you were making 5% interest on it, you thought, I'm collecting 25 million a year, you'd feel good. If the bank called you and said, okay, instead of 25 million a year, we're giving you nothing, you would feel less good. And if you started watching television and you read that in fact the Federal Reserve was going to print another 10 or 20% more money, and then you started thinking that in fact your capital was going to be cut in half, and not only were you not going to get nothing, but they were going to take half of your existing cash away from you, then you would feel bad. And at the point that you started to recognize the fact that not only were you going to get nothing, but they were going to take what you have and give you nothing if you did nothing about it, then you kind of start thinking, maybe I should do something about that. And I think that's where we got to this year.
Got it. So it's still like, just for someone who was not following your latest journey, right? I want to remind that, so there was a quarterly earning conference, right, somewhere in July, and where you announced that you have an intention to purchase, like a large amount of Bitcoin, gold, and other alternative assets. And we can talk about your other bets. And because instead you thought, like, what? Exactly for the same reason, right? Why would I hold cash if I'm losing, the money? Because the inflation kills the cash, right? So I guess you've analyzed, some of the best options, so inflation resistant, and you basically amassed first 21,454 Bitcoins, and then which was about $250 million acquisition, and then the next one was 175 million, right? And it's literally recently it happened, in September, right? So I guess I know you've talked about it a little bit in previous podcasts, but I want to understand, I think, and my audience will be also interested, how would you even acquire such a huge amount of Bitcoin and not touching, not moving the markets?
We put together a world-class set of trading relationships, and then we used intelligent trading software so that we could actually break our orders up. And we were doing programmatic trading so that we probably did 170,000 transactions, one every 3 seconds for 8 days. So probably the first one was 3 or 4 days of trading every 3 seconds, and the next one was 4 days of trading every 3 seconds, approximately. And we're buying a third of a Bitcoin, a quarter of a Bitcoin. We're doing it. We're spreading it across every major exchange. You don't even know we're trading. And so certainly you don't go in and just try to buy 500 at a time or even 50 at a time or the like. You have to be patient. You have to have the right software. You have to have the right algorithmic programs. And so that's how we did it. I mean, which is, I think, how most institutions will do it going forward. I rather think the future of Bitcoin trading is it'll be computers working for the buyers, talking to computers working for the sellers, and there's no human beings in the middle of it. If you want to buy this much, you're going to put in an order to buy $50 million in the day, and you're going to go to sleep, and you're going to let the computer chug away. And then the real issue is, what are the parameters you put on the order? But you can't physically do it yourself sitting at a keyboard. And so we didn't. And I don't think any large institution will.
But what's, I would say, impressive that you've never changed the price. So you've never made like this huge spike in in Bitcoin price. Why? Because you did it so intelligently, right?
Yeah, I don't think anybody really knew we were buying it at all. In fact, the only time we aggressively purchased was when a trader or a seller panicked. So what I said, it's kind of ironic, right? So we're hoping for panics, and if someone panics, like someone says, "Oh well, the dollar got stronger," and they start dumping, and the price moves down $300, and someone's dumping on the market. I'm the guy saying, "Okay, well, buy 10 million of that, and or I'll buy 20 million worth of it in a minute." But I'm not chasing it. The guy that dumped it thinks that he's getting the better of me, right? So I said in one of my tweets, we would just sit in the market and we would buy at the market for 80 hours at a time, but we'll place some kind of very aggressive algorithms that are $200, $400, $300 below the market. Mm-hmm. And if the market sits normal, it would take us 24 hours to get what we wanted. But if you decided you wanted to dump 1,000 Bitcoin on the market now, we might buy it all from you in 3 seconds because we wanted to get ahead of everybody else. So it's one of those things where we go very, very fast. Like we could buy $20 million worth of this stuff in 15 seconds or in a minute or 2 minutes if we find a panicked seller. Under no circumstances ever would we be a panic buyer, right? And so that's the way we did it. And when you have that kind of algorithm, that's why the volatility goes away, right? Because you have somebody that would like to buy a lot of it, but they don't want to chase it up, so they put out of the money purchases, and that damps the volatility naturally. But look, from my point of view, I think once you've decided that you want to own $100 million worth of something, say Bitcoin, you buy it because your concern is, like my concern is not, oh, you want to sell it and I want to wait and see if I get a better deal. I'm not going to wait to see if it goes down by 20%, because if I wait, someone else will step in front of me and buy it when it goes down 10%, and then I didn't get it, and then I have to pay plus 20% for it, right? So once you've decided that you're short and you want to buy it, you put in a very large order to buy it if the price spikes down, because your real fear is you don't buy it and the price jumps 10%, and then it jumps 10 more percent, and then you have to chase it up and you have to pay 20, 30, 40, 50% more for it. So, so in that particular case, it makes sense that you just go about your business, and when you have an opportunity, you seize the opportunity.
So is it fair to assume that most of your acquisition was also bought with it? So you actually bought in with a discount, right?
Yeah, we got good pricing on it. I mean, I was very, very pleased with regard to the way the trades went. I think the summary is you just have to be patient, and you have to have very good trading relationships and good trading software. Mm-hmm.
Well, if the time is on your side, you can be patient. Yes, of course. So that actually creates a pretty interesting arbitrage opportunity. So if you buy it with a discount, you could have immediately, like, sold it a little bit with a profit, but you decided not to do it because you have a different strategy. So now,
yeah, well, yeah. To be clear, we're not traders. Mm-hmm. For example, if I told you in the year 2011 that Apple Computer was a really good company and eventually they're going to eat the world and everybody in the world is going to be using an iPhone, and if Apple Computer stock was trading at $5 a share, which it was split adjusted, and you could buy $100 million of it, wouldn't you just buy $100 million of it and hold it until it went up by a factor of 20? Right? If you were to say to me, if I'm telling you the future, I'm saying, Constantine, this is Google, they're going to go up by a factor of 20. This is Facebook, they're going to go up by a factor of 30. This is Apple, they're going to go up by a factor of 30. Would you then say to me, I can't wait to buy it and sell it and trade it because it might go down? You don't sell volatility. It sounds cute, but let's say you buy $100 million worth of it, it goes up by 10%, and then you sell it, waiting to buy it back. It might not ever come back. It probably won't come back. So the winning strategy, if you know the future, is just buy the thing. If I wanted to sell the thing, I wouldn't have bought the thing, right? So the truth of the matter is, if you're buying Bitcoin at 10,000, you're buying, and you believe in Bitcoin, you're holding it until it goes to 500,000, and you're having a little debate between 100,000 and 1 million, whether you sell 5% of it, or whether you take a little off the top. But the point is, you bought it because you thought it was going to go up by a factor of 10. So if I said to you, you can buy it at 10,000 and sell it at 11,000, and you might be able to buy it back at 10,500. Well, yeah, you might, but you might have to buy it back at 100,000. And you feel pretty stupid if you have to buy it back at 100,000 because you wanted to make $500 profit on it. So I say it like this. If you're so smart that you know the future perfectly, then maybe you can buy it and sell it 27 times. But I'm not that smart. If you're smart enough to have a general inclination that in a decade it'll be worth more than it is now, the best idea is just buy it and wait. And don't try to trade the market. I mean, there are people that know how to do it. But as a general rule, it seems to me that people that make billions and billions and billions of dollars, they didn't make it by trading Apple stock up and down over the last decade. They didn't trade it by buying and selling and buying and selling Google stock. And they didn't, buy and sell and buy and sell and buy and sell Facebook stock. They just bought it once. So, which brings us to the next question, right? So you've announced this 100 years view, right? And respectfully, I wish you that you would live 100 years more, right? But we all have our time, right, which is quite limited. So my question is, what's your exit strategy in this case? I think that the point of taking a 100-year view is because when you look out 100 years, it's very clarifying. It causes all the noise that causes people to make investment mistakes to drop away. So with regard to an investment in any treasury asset, the reason that you have a treasury is because you want to endow an institution. Maybe it's your family treasury. You want to endow a family. If you have children and they're going to have grandchildren, you have a treasury for them, a trust. If you have a company, you expect the company to last. If you're endowing a treasury of Harvard University, you expect it to be here 100 years from now. If you believe in save the whales, save the seals, save the park, save the environment, save the earth. If you believe in your God, your religion, whatever your values are, if you look out 100 years, if they're really strong values, 100 years is not too long. And even if you think, well, I'm only going to live 30 years or 40 years, the best thing to do is look out 100 years, because it allows you to get rid of all the noise and clarify things. So with regard to what we did, we were making a treasury investment for the good of the company over the long term. Remember Warren Buffett's phrase, the preferred holding period of any stock is forever. You buy a stock because you expect to hold it forever. If I'm thinking that in 9 years the company is going to be destroyed, and I buy the stock now, am I going to wait 8 years and sell the stock? Because in 7 years, someone's going to write a report saying that in 9 years it'll be destroyed. And someone else in 6 years might write a report in anticipation that the guy 7 years from now will write the report. So the rational market theory says, if I know the thing is going to end in any period of time, I have to act now based upon the value of discounted cash flows, and I got to sell it, right? So we didn't have an exit strategy. We had a treasury. To say what's your exit strategy is like saying, how do you plan to kill yourself? Well, I don't. Well, how do you plan to kill the rest of your family? Well, I don't. Right? How do you plan to withdraw all support from all those things that you love? Well, I don't. By definition, I didn't love them. It's like when you get married, what's your exit strategy? Well, it doesn't sound like a marriage for love, right? So there is no exit strategy for a true treasury, because the whole point of the treasury was to have it in order to keep you alive, right? An exit strategy is a suicide strategy. So I have a treasury. I have something I love. The something I love is a company. I have a fiduciary obligation to love it, right? If I didn't love it and I was just a businessman, well, I'm the CEO. I'm supposed to protect and cherish the thing, and I've made promises to my customers. And by the way, maybe the average life expectancy of a customer is a bit more than 20 years. Like if they buy our software, they'll stay with us for 20 years. But in 18 years, someone's going to take over for that customer, and maybe they've got 20 years. The point is, you have to have a continuous view of the world. And so that's very clarifying, because now the issue is you have $100 million. That's a nice block. Let's just do the experiment. A very good way to evaluate any investment is take $100 million and move it forward 100 years and ask the question, what happens? So if I had $100 million worth of currency in any of the 100 largest cities in the world in the year 1900, and I went forward 100 years, and I put that money into the best bank in that city, I have two types of risk. I have counterparty risk and I have inflation risk. The counterparty risk problem is that the biggest bank in Japan, in Tokyo, in Paris, in Berlin, in Moscow, in Beijing, in Rio de Janeiro, in every major city in Africa, in every major city in the Middle East, failed in the 100 years. So there's a 90% probability you lose everything, because you had to have your money in maybe a Swiss bank or an American bank, not to have law, and maybe London, Geneva, Zurich, or New York City, and you would have kept your money. Everywhere else, you would have lost your money, all of it. So let's assume that you're smart enough to put all your money into New York City. Well, at 7% inflation, or 7% monetary expansion a year, that means in 10 years, your money's cut in half, which meant that your 100 million went to 50 million, 25 million, 12 million, 6 million, 3 million, 1.5 million, 0.75 million, 0.35 million, 0.17 million. In 100 years, you've got certainly a lot less than 1% of your money left at 7% expansion. So that doesn't work. So let's put the 100 million into gold. We'll try that again. Okay, you put it in Beijing, you lost it. You put it in Tokyo, you lost it. You put it in Berlin, you lost it. You put it in Paris, you lost it. You put it in Amsterdam or Brussels, you lost it. You put it anywhere in South America, you lost it. Put it anywhere in Africa, you lost it. Okay, so put it in New York City, because we won every war in 100 years, right? Except that in 1932, Franklin Delano Roosevelt outlawed it, and you lost it. There's counterparty risk. Okay, name one city in the world in the 20th century you could have put your gold in where the government didn't seize it.
Good question. Yeah, it depends which period, but I tend to believe like right now, more or less Singapore might be the contender. Maybe, again, there's no reason.
No, because the Japanese took Singapore in World War II. They stole everything.
Okay.
I'll give you a help. Maybe Zurich.
Yeah, well, not
Switzerland.
From the list that you have already mentioned, right? Yeah, Switzerland. Yes.
Not Spain. Their government turned over. They had a Spanish Civil War, right? Yeah. I think the only one I can find, Constantine, would be Zurich or Geneva. That's all. You can keep maybe London, but I don't know. I think the British kind of seized the gold too, and so. Bottom line here is not easy. There's a 95% likelihood that the counterparty risk seizes your gold. The bank will seize it or the government will seize it. So let's assume they don't. Mm-hmm. Well, gold miners are mining at about 2% a year. So 2% means that every 35 years the gold supply doubles. That means that your money gets cut in half 3 times. So your 100 million goes to 50 million, goes to 25 million, goes to 12 million. Under the best of circumstances, if gold didn't go up in price too much, and if it didn't get seized, you lose 87% of your money. By the way, that sounds positively extraordinary compared to fiat currency, right? So when gold bugs talk about how good gold is, they're comparing it to cash or maybe stocks, which are even worse. But it's still awful. If you think about it, compared to what happens if you if you take 100 million and you put it into Bitcoin. Well, the nice thing about Bitcoin is all you got to do is you don't have to like keep it in one bank for the entire time. All you got to do is know that you could move it from here to there, or you could find one place in the world where they're not going to club you overhead and take it. So it's a much more anti-fragile exercise because you can be your own bank, or there are a lot of other custodial solutions other than the largest bank in the city with the big vault. Mm-hmm. You put gold in a vault, there's a big bullseye on it. It's very hard to move it. It's heavy. It's big rock. Try to walk around with a few $1 million of gold on your person and see how noticeable that is. So it's a challenge. Now so you look at the treasury assets, you say, well, fiat doesn't work. I lose 99% of my money. Gold doesn't work. I'll probably lose 90% of my money. Bitcoin, that kind of works. Well, what about stocks? Well, stocks are interesting, but take the best company in the world. They have payroll taxes. They have tariffs. They have corporate income taxes. They have regulators, right? If it wasn't for regulation, the most valuable companies in the world, they wouldn't be Apple, Amazon, Facebook, Google. They would be the local electricity company. Mm-hmm. Because if I turn off the electricity in New York City, everybody's going to die. If I turn off the water in New York City, everybody's going to die. So why isn't there some guy worth $100 billion that runs the water network or the electricity network? Why? Because
that's kind of monopoly in a way, right? Like we do have like Con Edison here, right? They're in a way they're monopolists.
Well, you could say they became so important that the politicians decided that they couldn't be allowed to set their own prices, and they got regulated.
Yeah.
Right? And at some point, when a company gets to be so important that it's a utility, then the politicians get involved, and that's the regulatory risk. So as a store of value, if you're trying to use a company as a store of value, what's the likelihood that the company's not going to fail, or the municipality, the state, or the federal jurisdiction is not going to impair the asset? They're not very portable. Generally, they get broken up, they get regulated. They're probably not good for 100 years. And what happens if a bad CEO comes along and wrecks it? Right? There's no CEO of gold. I mean, it's a dumb rock. But there are CEOs of lots of companies that have destroyed the companies. I mean, it does happen, right? Occasionally, an organization has a bad leader. And one bad leader can wreck 100 years of damage on any kind of institution. So that leaves us with real estate. So let's take your $100 million of real estate, go buy land in California. What's the real estate tax or the property tax? The property tax in Florida is 2%. If you buy $100 million worth of real estate in Florida, you're going to pay $2 million a year in tax. Doesn't take a rocket scientist to figure out that that means you lose your land in 50 years. Which means there's nothing 100 years from now if I tax it at 2% every single year for 50 years. And if I mark it up to market and I appraise it as 10% more valuable or 3% more valuable, you'll lose all your property in 30 years. So it's not really practical to take $100 million worth of money and move it 100 years forward in most vehicles, and they don't make good treasuries. What I've pointed out to people is that Bitcoin is the most efficient system for channeling energy through time and space in the history of humanity. And most people don't really understand what I mean when I say that. And here's what I mean. If you had $100 million worth of electricity in New York and you wanted to deliver it to someone 30 years from now in Tokyo, you couldn't pump it through the power system. Electricity only goes on a power network 500 miles. You're going to lose 6% of the energy by the time it gets to a home and it goes through the high voltage and the low voltage lines. And then you're going to put in a battery, and the battery is going to lose 2% of its power every month. So batteries have an inflation rate of 24%. A gold battery has an inflation rate of 2 to 3%. A fiat battery has an inflation rate of 7%. I need the battery to hold the charge for 100 years. Bitcoin will hold your electricity. I can paddle on my paddle board to make $100 million worth of electricity. I can sell it to the grid and get $100 million worth of cash. I can buy $100 million worth of Bitcoin. I can put it on the blockchain. I can forget about it, and I can pass it down to my heirs' heir. And 100 years from now, they can take the energy out of the blockchain, convert it back into the local, galactic credits of the time, or the Federation credits, and then they can buy some power and they can use it to power up their Starship yacht thing. And they've done it without losing the energy. It's a way to channel energy. And that's what's so special about it. You can't do it with real estate. You can't do it with gold or silver. You're not doing it with paper money. And you can't do it with a NASDAQ stock. They all have too much inefficiency, impedance, or counterparty risk.
So you would say that, let's say, treasury bonds or something like treasury inflation protected securities is also not an option.
First of all, I think that the problem is it's a defective concept. The treasury inflation protected security is based upon CPI. CPI is an arbitrary basket of products and services that will never go up in price. So, for example, there's a million things you might want. Like, here's one thing you might want, Constantine. Wouldn't you like to work for 10 years and retire and never have to work again? Something?
Yeah, I guess yes.
How many people in the world would like to retire at age 30 and never work again?
I guess a lot.
It's something. You might want a Domino's pizza, and you might want a Netflix movie. Okay? Netflix movies are not going to go up in price no matter how much money the Fed prints. A Domino's pizza with a low variable cost and a high modular manufactured component is going to get stamped out, and it might go up by 3%. On the other hand, a government bond that yields 6% interest would give you $60,000 a year for the rest of your life if you had $1 million to buy it in the year 2009. In the year 2009, you could have paid $1 million to not work again the rest of your life. And, you know, some places you can't live on a 60,000, but, you know, on a beach in Acapulco, you could. So that same bond this year yields 60 basis points, which means that it costs $10 million, which means that in about 10 years, the cost of the bond went up, the asset went up by 1,000%. And if you back solve, that means that the inflation rate on an asset, on a retirement annuity, was 22%. So the real inflation rate on something you want, like early retirement, is 22%. The real inflation rate on a sick apartment in Manhattan that everybody wants is a lot more than 2%.
Oh, yeah.
Stuff that you really want, a Picasso, right, is going up faster than the CPI. And so CPI is kind of like a Jedi mind trick idea. I'm going to define a basket of things that everybody can have that aren't scarce, that are abundant, that have low variable cost. And then I'm going to give you a bond so you can buy them. But the point is, in 20 years, that bond will let you buy Netflix streaming videos and manufactured cheese byproduct out of a factory generated by a robot. It's not going to have enough purchasing power to buy you a jet, a yacht, beachfront property, or an early retirement. And so it's not that interesting to buy those things. And to define inflation as CPI is the pernicious misconception. Inflation is not CPI. Inflation is a vector. And that means that there are lots of different numbers, and every single thing you might want in this world is inflating at a different rate with a different coefficient. And if you want to figure out what that coefficient is, ask the question, how much energy intensity and scarcity and demand for that thing is in that product? The things that people really want, like, I would like to own all of Manhattan, all of it.
It's a good ambition.
That would go up in price a lot, right? On the other hand, you could own, why don't you take the 20 square miles or whatever, the 100 square miles of Manhattan and calculate the inflation rate of that since 1800, and then take 100 square miles in the middle of Des Moines or Iowa or Wyoming and calculate the inflation rate of that since 1800. And you'll see that one of them is more in demand, one of them is scarcer. And if you want all of the paintings that Picasso ever painted, they're going up in price. But if you just wanted a digital copy of a Picasso painting that's stamped out 18 billion times on Google, it's not inflating. So pick your market basket of things you want, then you will calculate a different inflation rate. And then it will change your worldview as to what assets you should put in your treasury to protect your purchasing power over the next 10, 20, 30, 50, or 100 years.
Yeah, that's really interesting explanation. Like, you know, because my other question was like, how do you even possibly explain it to, again, you're a publicly traded company, right? So I'm sure you have a board, you have people who advise you on certain moves, you know, you have people who have to convince to do those, like, you know, I would say rather ambitious steps, right? So, and I think you've explained it partially. How would you convince them, like with the numbers, with the different examples of alternatives? How would you actually invest $100 million, or in your case, $425 million, right? But I'm still interested, like, you know, what other arguments were, like, I would say, accepted the most in your explanation, or any of the person that helped you to do that? You've mentioned that Eric Weiss, if I'm not mistaken, who helped you to just, you know, to inspire you to even look this way, right? About asymmetric returns. Yeah.
I would say Eric was the instigator. He's a crypto hedge fund operator, and he'd been in the business 3 years earlier, or 3 or 4 years before me, and so he had been talking to me about it. And I was oblivious to it into 2020. I just didn't really focus on it that much. I think that once we saw all of the change that took place in the macroeconomy post-pandemic, then I became much more open-minded, and he started to educate me. And my path to appreciate all of these things was to start to surf the web. You can learn just about anything on YouTube, by the way. You know,
Yeah.
you go on your own podcast, you have a wealth of information. You know, generally when they go into lockdowns and the pandemic, right, there's two reactions. There's you feel sorry for yourself, and then you start watching Netflix. and then you start watching everything on Hulu. And after you've watched everything on Netflix and everything on Hulu and everything on Amazon Prime, and then you're watching Jerry Seinfeld reruns, and you've watched like the first 4 seasons, you start thinking that maybe I need to start doing something else with my time. Okay, so you can either go down that rabbit hole of watching reruns and watching bad television and good television, or you can go on YouTube and you can decide you're going to get educated on inflation and debt and investment and technology. And then once you do that, and invariably you discover documents on Medium, and you find documents on all these websites, and you find that there's an extraordinary community of people on Twitter, on YouTube, on Medium that are very thoughtful, and they're rising above the noise. It used to be we got all of our information from, you know, the one investment bank or the one library. And now you have all of these brilliant, thoughtful people that are creating their own podcast, that are creating their own websites, and they're not working on, you know, as a mid-level professional in the middle of a mega conglomerate bank, but rather they're an individual and they're a specialist. And if they're really good, if they work hard and they produce good content and they study, then they will go from 1,000 fans to 10,000 followers to 100,000 followers to 500,000 followers to 1 million followers, and they become the Joe Rogan, right, of the whatever. And
yeah.
And we've seen that explosion of content producers. And if you want to find the best and the brightest, you will find one, and the one will introduce you to the next one. And then pretty soon you're not binge watching Seinfeld anymore. You're learning, and a little bit of learning will go a long way. First of all, it changes what you think, change what I thought. And then after that, I bundle up some of these videos and I would send them off to the board of directors and off to other executives in my company. And everybody gets an on-demand streaming seminar of the issue at hand. And that allows us all to get rapidly educated and come up to speed. You know, it's 3 years ago, people went off to conferences, crypto conferences. I have to go to this meetup. It's about 1,000 times more expensive to go to the meetup.
Yeah.
I mean, like, there's no way I'm ever going to get the board of directors of a publicly traded company to stop what they're doing and go to a crypto meetup to get educated. So the new world of streaming on-demand content is kind of critical if lots of people are going to come to consensus on sophisticated new ideas fast enough to make a difference.
So if I were to ask you, like, what are the top 3 either like research papers or people who influence the decision of your board? I'm just curious.
Well, you know, I would say there's some real seminal documents in the space. I thought the Bitcoin Standard, the book by Saifedean, The Internet of Money that Andreas wrote, the Bullish Case on Bitcoin by Vijay Boyapati. I think the entire essay series by Parker Lewis, Gradually, Then Suddenly. I think the body of podcast by Pomp, you know, and Stefan Levera and What Bitcoin Did, Peter McCormick. I think all of those have quite a bit. And I think Lynn Alden wrote a very influential paper, Why I Become a Bitcoin Bull, earlier this year. And she had gone from being a skeptic in 2017 to being a bull in 2020. And I think that was that's material. And I think the influence of Michael McGlone at Bloomberg, I think that's also relevant. And I'm sure I left some stuff out, but off the top of my head, those are all I think critical elements to this journey.
No, I couldn't agree more. Like, and again, there's a lot of people who contribute to the industry, and I respect them all. I also listen to most of them as to educate myself. And so I would also ask you, like, okay, right now you have in your treasury, like, this, I would say, kind of large portion of Bitcoin, right? So what is the next step? Like, are you looking at derivative market? Because I know, like, lately, like, in May, I guess, like, it was a spike of 32%, like, all times high, like it was $602 billion trading. Then it was like, it was a bit lower. Then it was 1.2 trillion, but it's still, like, relatively small if we compare it to the traditional derivative market, which is estimated with about like $640 trillion, right? It's a drop in the ocean, right? So there are a lot of predictions that the market will grow tremendously, and that brings a lot of more active strategy. Like, so you still have exposure to your Bitcoin, but you can lend it, you can trade it on derivative exchanges, you can apply like covered call strategies, a lot of different like options. So are you looking at this right now, or are you already actively applying those strategies?
When I think about Bitcoin and Bitcoin as an operating system, here are my thoughts. First of all, there is the potential for loaning, for borrowing, for trading, for for working and for selling volatility, buying volatility around Bitcoin. But I don't think it's a first order critical thing right now. I think that it's good that that it's possible. And I think that as crypto banks form and crypto traders get stronger, and as they build out the yield curve and they sell the future and buy the present and lock in the spread, it goes into contango, and that's an opportunity. It goes into backwardation. That's an opportunity. I think those are things that draw liquidity into the business, and they'll draw capital in, but there's secondary effects. You don't need to engage in any of that behavior if you've adopted Bitcoin as your treasury reserve asset. Doing it is like, I've got to do 100,000 things that are very complicated and do them all well in order to get 5% advantage. But on the other hand, I could just leave everyone else to do that and just hold the Bitcoin and let it sit there and do nothing, and I still get the advantage. Because to the extent that someone else can generate a huge interest rate on Bitcoin by trading it, then that means that they're going to draw capital into the market, and they're going to buy the underlying Bitcoin and drive up the price of Bitcoin so they can get that yield. If you're just sitting on 100 Bitcoin when everybody else does all this complicated stuff, your 100 Bitcoin are going to become worth more, because the entire ecosystem of Bitcoin is expanding due to all the other players in the ecosystem. So here's what I think that there are two very complicated things you can do. One that I think is hard and maybe has merit, and another thing that I think is hard but isn't worth the trouble. The hard thing that has merit is to be a trader and a banker, and either to loan it out or to borrow it or to pledge it or to build a yield curve and to trade it if you're doing it in a rational hedged fashion. That's a hard thing, and it's a business, but I don't have any problem with it, right? It's just a business. I don't feel a need to do it. By the way, it's hard to mine Bitcoin, right? I don't necessarily need to do that either. I'm glad people do it. They'll make a lot of money doing it. It's a very technical business. Banking it is going to be a very technical business. You should be good at it. You should be dedicated to it with all your heart and all your passion, and you better understand the mathematics and the economics, or else you're going to lose all your money, right? Those are different businesses. There's another thing people try to do with Bitcoin, which is they try to either sell products and services in Bitcoin or pay off their employees or their vendors in Bitcoin. That's a hard thing to do, but I don't really think has merit. I don't think people should do it. I think that the right way to hold Bitcoin is you buy $100 million worth of Bitcoin. I have subsidiaries in 27 countries. We operate in euros, yen, won, pesos, real, and dollars. I pay my employees in local fiat. I take local fiat from my customers. I pay my taxes in local fiat. I pay my vendors in local fiat. If my customer wants to pay me in Bitcoin, and by the way, none of them do, right? Because 99.99% of all the customers have fiat currency in their country. They won't. If they did, I would say, you sell the Bitcoin, pay me in euros, and I will take it into my euro account. If my employee wanted to be paid in Bitcoin, I would say, I'm going to pay you in euros. You take the amount you want to Bitcoin, and you go buy Bitcoin and put it into your personal cold storage wallet. We basically use fiat currency as our working capital. If I have 27 subsidiaries, I have 27 working capital bank accounts in the fiat currency of the country in question. When I have when I have 10 million euros and I only need 5 million euros, I sweep the 5 million euros into dollars. I convert it. I put the dollars in the treasury, and then over time I buy Bitcoin with it. Right? If I generate 30 million in cash flow a year, it goes into treasury. I'll end up buying 30 million worth of Bitcoin a year. If we have a profitable company for 100 years, I will never take anything out of treasury. I will sweep fiat into the treasury, into dollars, convert the dollars into Bitcoin, put the Bitcoin into the treasury, cold storage, and we'll stare at it and we'll wait for it to go up by 10% a year or X% a year, and we'll never sell it. And the reason that you never want to actually issue it to someone in payment of a debt is because if you worked for me and I paid you in Bitcoin, and Bitcoin is trading at 15,000 a coin, and I bought it at 10,000 a coin, I would pay capital gains on 5,000 a coin. And so I would generate a $2,000 tax bill just by paying you with it, which makes no sense, right? I'm accelerating my taxes. My long-term capital gain becomes short-term capital gain, and my untaxed capital gain becomes tax capital gain. And instead of paying tax in 100 years, I'll pay it now. And so it's obscenely tax inefficient. It's worse than that. If I pay 100,000 people at 100,000 different times, the price of Bitcoin is going to be different every time I pay them, right? Which means it's 100,000 different capital gains rates. The price is changing every day. It's changing every hour. So that means I have to mark the Bitcoin to market, and I have to take my basis versus what I transferred it at, and that's the tax. So not only do my taxes skyrocket, my accounting complexity skyrockets. I have to rebuild all the accounting systems in every country. I have to pay tens of millions of dollars of taxes for no reason. Mm-hmm. And then every one of my employees has to set up their own account. And then when I pay them in Bitcoin, they have to sell it and pay the commission so they can put it back into fiat so they can pay their rent. So it's a heroic, romantic idea, but it's totally impractical and unnecessary. As a practical matter, generally any institution and any individual, they're not going to need more than 2 or 3% of their assets in a working capital account. Mm-hmm. So if you have $100 million, put $3 million in working capital in fiat, and then use conventional financial tools to pay, and buy things with it, and you'll be just fine.
No, I agree. I think my question was more geared towards treasury management. For example, if you do 100% collateralized loan in Bitcoin and you earn, like, let's say 5% on top of what you already have, right? So you still have an exposure to Bitcoin, right? But you also can earn extra, I would say, just by lending into the market, right? So that's, yeah.
I think it's an interesting idea, and in time, when the crypto banking segment matures, at the point that there's a bank that has $10 billion in the balance sheet and $1 billion in reserves, and they're ready to give us 6% interest, we might put our money in that bank and take the 6%, but we'd have to know that they have to be Sarbanes-Oxley compliant. They'd have to comply with the Foreign Corrupt Practices Act. I'd prefer that they be a publicly traded bank because I want the officers to be criminally liable for lying to me. And I would have to be, it's like if I said to you, Constantine, I have this scuba tank. It's a new kind of scuba tank. It'll last for 3 hours underwater instead of 30 minutes underwater. And you've been using another kind of scuba tank for 30 years. And then you're going to use this one the first time. And then you say to me, Mike, who else has done this? And I go, well, nobody. You're going to be the first. Or, my sister did it. And I think it'll work. We've been doing it for 90 days now. You're not going to trust your life in the first 90 days. You're going to have to see that it's 3, 4, 5, 6, 7 years old. Someone that you trust is going to have done it before you. And you're going to have to be sure that it's been tested with all the right fail-safes before you're going to risk your financial life to it. So I think that there's potential, but it's all just too early. And the risk of doing this is much higher than the reward. And there's still a lot of other questions like, is this going to be DeFi or CeFi? You don't need a decentralized exchange to do all this stuff. You don't need Uniswap or the like. You could do it on a centralized website.
Yeah.
But at the end of the day, I'd be more likely to do it if JP Morgan offered it to me than if a startup with 30 million in capital offered it to me. If the bank has less money than I have, would you put your money in a bank where the bank had less money than you had?
Well, to be frank with you, it depends, because it depends if you're putting it with the bank. Right now, there are a lot of sophisticated technologies which allow you, even if you're a regulated advisor, let's say, right? And most of the advisors obviously don't have more money than their clients, right? So they're just they're facilitating a service, and there are other, I would say, trusts, who have, they have billions, and there might be even FDIC insured. And we've seen lately the news where Kraken just got a first charter bank in Wyoming. So, and there will be more like that. But for now, the market's still operating. Genesis is issuing billions of dollars and, equivalent of Bitcoin in lending, and it works somehow. I know several big institutions who actually use them. So it's not only a bank, but again, it's a long discussion, right? So I understand your logic behind it, right? So you want to make sure it's a legal, compliant, and trustworthy counterparty, right? I
would just say it's interesting. It's just we're year 1 or year 2.
Yeah. No,
we're going to have to get further down the road. There's a consumer loan business where people are often offering crypto loans to consumers at 7, 8, 9% interest, and that's forming. And as that grows, maybe there's a point, right, at which you feel comfortable. But Binance, for example, is one of the bigger players there. If you're a U.S. citizen, you can't do business with Binance. So you've got to work through the state regulations, the federal regulations, the international regulations. And after you get through the compliance issues, you have to then get through the credit issues. And maybe I trust the individual because they're pledging their Bitcoin, but then I got to trust the counterparty or the bank, right? And we just saw one of the exchanges just failed this week, right? Yeah. And so you have to get to the point where whoever is the bank is well capitalized and trustworthy. I think that if you ask this question in 5 years, the answer is there's going to be a number of very successful crypto banks. And if you ask the question in 10 years, I think you're going to see that there's many, many billions, if not tens of billions of dollars of capital there. But I think that the industry has to go through its growth, and it has to develop a degree of familiarity in all the regulatory jurisdictions such that there's predictability. Because the uncertainty, right? The uncertainty is maybe you'll give me 6%, but on the other hand, if I do nothing, I expect to get 30%. So if I'm holding Bitcoin expecting to go up 25 or 30% a year, then why would I risk losing it all to get an extra 5% when I could risk nothing and get mostly what I want, and I wait until everybody breaks and then I figure out who's going to be successful, who's not going to be successful, and then I can make an informed decision. So I would say the people that are doing it are going to be the venture capitalists, people that are more risk aware, they're more risk capable. And if you're running private money and it's in a risk bucket, then yeah, you're gonna go and sell that volatility. You're gonna take that risk. If you're running money for an insurance company and widows and orphans and pension fund, you're going to be hyper conservative, and then everybody's got their place in the middle, and then the industry is going to evolve.
Yeah. Well, I hear you, and trust me, I do understand your concerns, and we had multiple conversations like that, but there are multiple ways how you can do it still, and I would say, so that you don't lose your 30%, that appreciation, and also get extra 5%. So there are ways already exist, and they require more, I would say, education and separate, like, if you prefer offline conversation.
Yeah, Constantine, I understand, but still, I think, let's go back to the example of Apple.
Sure.
You buy $100 million of Apple at $5 a share. If you can see the future, you know it's going to $100 a share. You're going to make $2 billion. It doesn't matter whether you loan out the stock. Every billionaire that ever made money on Apple, Amazon, Google, Facebook, none of them loaned out the stock. In fact, every billionaire on the planet, Microsoft, Apple, Amazon, Facebook, Ralph Lauren, all of them didn't make their money by loaning out their stock in order to generate yield. So it's a second order thing. It's not the prime order thing. If Bitcoin goes from being worth 200 billion to being worth 20 trillion, it won't matter if you loaned out the Bitcoin. And if it doesn't, it still won't matter, right? So it's a second order business activity. The first order question is Facebook going to be the dominant social network? Is Apple going to be the dominant mobile network? Is Google going to be the dominant information network? And is Bitcoin going to be the dominant monetary network? And if you answer that question, then you've already won, and everything else is just entertainment.
Exactly.
On the periphery.
And I agree with you. There is no contradiction between us. There are different strategies, and you're right. Like the way you manage your treasury, and obviously you're successful, and obviously you're running a public company, and you've been through your down cycles, you've been through up cycles, and you survived all these challenges, right? So I'm not here to tell you that you have to do something differently, right? What I do believe that there are a lot of interesting alternative I would say ways how to also maximize the returns. And again, you're right. Again, it depends on the profile of the people who are doing that, right?
Well, Constantine, you also you're leaving out the time scale. The United States of America has been issuing debt for more than 100 years, I suppose. Okay. So when a publicly traded company buys $100 million worth of federal debt, they're buying it at the end of 100 years of experience.
Oh, yeah.
If a publicly traded company is basically lending out or issuing, trying to generate yield on Bitcoin, they're doing it in the first year. So if you go forward 100 years or 50 years or 10 years, probably everything that you're talking about will happen, but it's a question of the life cycle of the asset class. And at this point, the reason I think it's important is I think that there are a lot of people in the crypto community that are really they're extremely technical and entrepreneurial enthusiasts. So they're very excited about improving the technology or all the cool things you could do with it. And I get that. But if you fixate upon all those things, then you miss the one big thing, which is it's important that Bitcoin be viewed as the most secure treasury asset. Mm-hmm. The best treasury reserve asset, a la better than gold. And if people view it as the safest possible asset, there's $100 trillion worth of money to flow into it. If they view it as an unregulated casino in Vegas, where lots of exchanges make up their own rules and there are a lot of cowboys and is gambling but with technology, then they run away from it. So is it the savings loan at the end of the universe, or is it Vegas unregulated in cyberspace? Unregulated Vegas in the Wild West Vegas in cyberspace, Deadwood Circuit 1873. And those are two different business models. The crypto world is a $300 billion pond of money sitting next to a $300 trillion ocean of assets. And that means 0.1% of the energy in the world is in the crypto pond, right? 99.9% is somewhere else. For the entire crypto world to succeed, you need to carve a little channel between that ocean and the pond. And you need to start by getting people that have money they don't want to lose and put it into the class. So if you could convince them that it wasn't going to lose 90% of its value and yo-yo like it's on fire, or if the average person thought Bitcoin was going to appreciate 5% a year, you would have $20 trillion flow into it. Mm-hmm. You don't need to reach for yield. All you need to do is convince people that they're not going to lose all their money. And so when 90% of the crypto community fixates upon talking about DeFi and talking about unregulation and talking about arbitrage and talking about yield mining and all these things, they're sabotaging themselves, because what you have is like, Sam Walton's daughter with $100 billion and an advisor working for her is trying to figure out whether they should put $3 billion into Bitcoin. And when all these people, get all excited about all these entrepreneurial crazy things, they just get kind of afraid and it gets complicated. And they're like, if I'm not afraid of it, like, who wants to go to Vegas unregulated without sheriffs and no rules? Would you gamble in a casino with no rules? Like, nobody wants to do that, once they're past the age of 65 and they're just rich. What they want to do is put their money in a savings account that's insured, that's going to generate 4% interest and not lose it. And your competition is government debt that currently yields on average 100 basis points. That's the competition. And so if you said Bitcoin will yield 200 basis points, you're twice as good as $100 trillion worth of assets. So it's an argument you don't have to win. You can get 25x your money if all you do is say it's twice as good as a long bond. That's all you'd have to do. And so young tech entrepreneurs running around 100,000 miles an hour trying to do all this complicated stuff, and I would say, just stand there, right? Don't do anything. Just stand there and don't drop the ball. I'm going to hand you the ball. It's going to be 10 times better than the alternative. Don't dribble it. Don't shoot it. Don't pass it. Just don't drop the ball, right? And then if you do that, and if the entire ecosystem grows by 20 or 30 or 40 trillion, then there's going to be a $2 trillion yield farming market. And everything you've said is going to be 50 times bigger than it is right now, because all those people that are afraid to do this stuff in the crypto world will have just put their money into the Bitcoin savings and loan bank, and we'll all be happy.
Yeah, I certainly agree with you. That's still like treasury, especially if several multi-billion companies that are public will actually like put at least 10% of their treasury into Bitcoin. That'll be a huge news. Like let's decide even one, as you mentioned, Twitter. Like if Twitter or Square, like Jack Dorsey will put like, we don't ask him to put 100%, like, but 10% will be enough. We're not greedy, right? So, and other companies, like dozens of other companies will follow. I think that will be a tremendous case study to showcase that this is no longer just a game. This is not gambling. This is just something that really works, and it beats inflation. It actually it actually does. So I think what you're doing is like incredibly important. Like because you are the pioneer, like in showcasing that this. Look at this. I'm not just I'm not just preaching this, like I'm actually like putting my money where my mouth is, right? So this is incredible. So that's why I 100% agree with you that we have to focus on something that is like there and that is already yielding and helping people to see the long-term, trajectory. So, but let me ask you like a few things. Like like just to change a little bit the topic, because we can talk about this. Like, I'm sure like for a while about the theoretical part. But you've also in your book, like you've like it was you issued it in 2012, if I'm not mistaken, right? So the mobile wave, and you talk about the evolution of mobile computing and the use of paper and the the new landscape and like healthcare and social world. If you were to write the chapter number 11, let's say, or 12, right, about decentralized networks and asymmetric return and something that is recession-resistant investment, what would that be?
It would be titled Bitcoin.
Great.
Bitcoin, the first successful decentralized network for implementing sovereign immortality. It's a sovereign immortal asset class. The the theme of the mobile wave is when software leaps off of a computer into your hand, it's possible to dematerialize cameras and microphones and books and entertainment and music and money and to create software which makes intangible, ineffable ideas like reputation and friendship, make them monetizable. And the theme, of course, is really great software requires a lot of imagination, because in cyberspace you have to combine the creativity of a fantasy writer with the scientific rigor of a science fiction writer. If I toss a baseball in a baseball field in normal space, it'll go 300 feet and is subject to laws of gravity and friction, and it will fall to the ground. And if you're an engineer, you know that you toss that baseball in outer space, it'll go around the Earth forever because there is no friction. And gravity works in 3 dimensions, right, differently. But if you're a science fiction writer, you'll be stuck there and you won't really conceive of the magic of the software. If you're a fantasy reader, you'll say tossing a baseball in cyberspace means that it can become a dragon, it can go and burn down the city of my enemy, it can fly back, convert itself into a bunch of doves, fly around me, and then drop into 12 seals which serenade me with a Mozart symphony as I lean back and sip a pina colada. And it's not science, right? It's magic. It's a magic baseball. You can do anything in cyberspace that you conceptualize. Just because you can do a thing doesn't mean you should do a thing. But when products became magic, when a Rand McNally map became a Google map, all of a sudden the map could tell you where the restaurants were, and then it could tell you that they closed last month, and then they could tell you that no one likes that restaurant anyway, and then they could tell you there's traffic on the way to the restaurant. And so the map became smarter, faster, and stronger than the previous map, and it also became infinitely manufacturable. And of course, Google Maps is worth 1,000x as much as Rand McNally ever was. And that's the dematerialization of a product. That happened with all sorts of products, and that's why Facebook, Amazon, Apple, Google are the most powerful, valuable companies in the world today. But what happened with Bitcoin is something a little bit different. It wasn't just magic money, because Apple Pay and Square Cash are kind of magic money by that definition. The magic of Bitcoin is it's a bearer instrument of digital scarcity, not controlled by a government or corporation. And that gives it a certain sovereign immortality. It gives it an anti-fragility. The company will fail, the city will fail, the country will fail, but Bitcoin won't fail as long as there's one node and one miner, maybe two miners, somewhere on the Earth, right? A few miners and a few nodes somewhere on Earth or in orbit, the network will keep chugging along. And that makes it the first example of a truly successful crypto network. Facebook, Amazon, Apple, they were all successful digital networks. Twitter's successful digital network. But Bitcoin was the first successful crypto network. And it sets the standard. It wasn't the first network to try. Lots failed before it. It may not be the last. People may form other crypto networks that are successful. There's tons and tons of competition, with all the other cryptos right now to carve out a niche. Are you application? Are you currency? Are you privacy? Can you do something that Bitcoin doesn't do? Maybe. But the challenge for all those other cryptos is they're going to have to do something that Bitcoin doesn't do, and Bitcoin does asset really well. And they're also going to have to do something that requires regulatory arbitrage or sovereign immortality, because otherwise Google will do it, right? It has to be something that Google and Apple are inappropriate for, because it's hard to compete with Microsoft, Google, Apple, Amazon, Facebook, right? It has to be something that, it has to be something that they can't do, because either the regulation, a good example would be if you have a lowest common denominator, because I do business in 100 countries and it's illegal in one country, I can't do it in any countries. Okay, so a decentralized network could solve that problem because they don't have that nexus. So if you can find a problem you can solve that a centralized digital network can't solve, that's important enough to be worth solving, that can't reasonably be solved with Bitcoin, then you can come to life as a healthy, organic crypto creature. And I think we'll have them. I think the market's ferociously trying to figure out what it is. And the market is just a Darwinian, terrifying, free-for-all in the jungle. And you get some very beautiful creatures, and a lot of mutations die.
Oh, yeah. There's a lot of black swan events, as you mentioned, like anti-fragile, like Nassim Taleb theories, and right now we're getting into crazy recession, which nobody can predict what's going to be the outcome, but we all know that it's not going to be good for sure, like especially for financial markets. But to stay on a positive note, right? I know that one of your, I would say, babies is the Saylor Academy, right? And you've put a lot of efforts to provide free education for, I would probably say, with millions of people, if it's accurate, right? Have you ever thought about actually creating the crash course of cryptocurrency 101 and then creating more advanced layers of education?
Yeah, I mean, the cause of free education is close to my heart. And the Saylor Academy it's at saylor.org, SAYLOR.org. If you go there, you can get a free computer science degree or a free chemistry degree or free education. And the idea is to give that to anybody that wants at no cost. The most successful course we had was English as a second language. And we broke it up into 12-hour modules, and hundreds of thousands of people want English as a second language. And we thought about that, and we thought, why? Well, I mean, you learn English, you get a better job, you make more money, right? So everybody wants English is a gateway to the job you want, to either selling something at a higher price or buying something at a lower price. So it's an economic gateway. So we've had the same idea, maybe Bitcoin for everybody, and a variety of crypto courses, and we packaged that as like a 12-hour module, and then maybe a number of modules, and we could have courses that touch on various areas of the business. And I expect we'll come out with something this year on that, and we'll make that free to the world. So it's a great idea. I'm impressed that you guessed that we're thinking about it, but I guess it's the logical next thing, because there are millions and millions of people that would benefit from a nicely packaged educational course.
No, thank you, and thank you for this announcement. I was actually, for some reason, sure that you were working at it. That's why I decided to ask, because it's so natural, like this transition. You disintermediate like access by also providing like a separate education. Like, of course, you can go to YouTube and learn, like, and hopefully, like the people who listen to this interview will learn a lot from you. But a part of that, like, you need like a proper, like, step-by-step course, you know, to educate yourself. I mean, Mike, seriously, Mike, that was a tremendous, like, you know, amount of knowledge I got from you personally. I'm sure that people who will listen to this interview will also have a lot of insights from you, and I really appreciate your time. I'm sure that you're going to be successful in your treasury management, and the 100-year view will be the winning view. And my only hope that other people will follow your great example, like, and they're going to also put billions of dollars into Bitcoin.
I think they will, and I think this is a very exciting time. It's an exciting year. A lot of good things are happening in the crypto industry. A lot of good things are happening for Bitcoin, and keep up the good work.
Yes. Now, any closing words? Like, what would you wish to the community?
My closing words are, I think that the crypto community is extraordinary, and it's full of very intelligent, progressive people that have a great vision and hope for humanity, and they're doing really neat and interesting things. So I really enjoyed getting to know a lot of them over the past 6 months, and it's actually one of the pleasant serendipitous outcomes of the year 2020 that I met so many brilliant, inspirational people. So I encourage everyone in this business that's interested and loves it to just keep doing what they're doing, because I think it's making the world a better place.
Thank you so much. And by the way, like, if someone wants to follow your work, I really acknowledge that you have a great Twitter. So please follow Michael on Twitter, because, you know, he's always posting every single day. He's posting some great things on crypto and specifically about Bitcoin. So I'm following you and learned a lot from that. So thank you so much, and wishing you more success in your treasury management.
Thank you, Konstantin.